Refinery and Crude Balances Lead at Rystad Energy, and Ram Narayanan, Director VP, Strategic Market and Business Development at Vedanta. Thanks so much, everyone, for joining us this Thursday morning. I'd like to have a look at that last question, actually, that Madeline had up there, which was to do with the other question, actually, the one about the second half. Carol, I'd like to go to you first. And you've got OPEC meeting in a few days, albeit virtually. The market more or less assuming at this point that nothing is going to change, and yet there's rumors of a surprise announcement of some sort as well. But one thing that OPEC would like to happen is that they can do something about these cuts in the second half of the year. So in terms of looking forward, is that something that OPEC, do you think, can rely on? Are we seeing signals in the market that that might actually happen or be able to happen?
Good morning, Diana. Good morning, everyone. Well, look, the way I look at OPEC, leaving politics aside and some internal dynamics that most of us perhaps are not aware of, just if I look at it rationally and I say OPEC announced those cuts to achieve a certain objective, and that is, if they tell us, to stabilize the market. And the market has been pretty stable. And for me, I interpret that as having a floor of around $80 a barrel. Now, the conditions from when they announced those cuts to compare them to what we have today have not significantly changed. So in that respect, since you have achieved market stability and any changes perhaps in your policy can destabilize the existing situation. And the second, the fact that the circumstances have not changed dramatically since those cuts were announced. So why would you go and alter that strategy? And again, I'm leaving politics and internal dynamics on the side, which could lead to some surprise announcements, but only looking at it from these market dynamics and OPEC's raison d'etre that the organization keeps on reminding us of, I say, why do you want to change a strategy that is achieving your objective and giving you more or less a satisfactory price level? There could be maybe some announcements that nobody foresaw, but I would find it very strange if those cuts are being relaxed at this stage of the market conditions.
Okay, thanks, Carol. Genevieve, let me go to you on that. As Carol said, prices have been very, very steady by all accounts compared to let's say, a 12-month scenario that we usually have seen in the last year or two. So steady as she goes. But, you know, as Carol said, it's why should they rock the boat? But they do desire higher prices, don't they? They really want to see it in the 85 to 90 range rather than where we've been. And, you know, many in the market are saying that they'll get that price, sticking to the cuts, but they'll get that price up to 90 in the third quarter, you know, as seasonal factors kick in. Now, are the indicators showing you that from a sort of a crude demand, a product demand point of view? Are we going into the usual seasonal demand, or will there be factors such as China growth that will be different this year?
Firstly, fantastic to be back here. Thank you for the invitation. I think I would tend to agree with Carol's comments in the most part, of course. We are looking at extreme tightness coming into Q3 in terms of the crude balance. But, you know, looking at the pricing level, it's a lot closer to the break-evens, and it's a lot closer to where the market would allow OPEC to continue to pump into. You know, the market consensus right now is looking at a complete rollover of cuts, or at least for most of the 2.2 million barrels a day. But in terms of where the pricing scenario lies, it's not as much as a raw crude price, but it's how deep the backwardation continues. And of course, OPEC Plus, we're looking at an extreme deeper backwardation, such that no stock builds occur. And that's something that we're already seeing some tipping points of, some stock builds here and there. We're looking at crude exports being high, but of course, crude on the water extremely high as well. And you're looking at light sweet flows or light sweet availability within Europe, especially being extremely high, such that, you know, tradable volumes are low as well. You know, OPEC Plus and countries within that are looking at a reduction in their market share and market revenue by continuing cuts. But what they are increasing is their revenue from the products angle and from the product exports as well. So coming into, and you mentioned this right in the question on the demand and seasonal basis, Q3 is the real demand basis for gasoline in the US and of course diesel in Europe, both of which are, you know, at opposite ends of the scale, I would say. But this is where OPEC Plus can really create some revenue growth, and I think that's where the targets do lie.
Okay, and that's the European picture, like you said, as you said, and gasoline, we've got the driving season in the US and the travel season in general coming up in the summer. Ram, good morning again. Let's get your point of view in terms of demand into Asia, into India, into China. Jenny mentioned diesel. I mean, what indicators are you getting in terms of economic sort of push from both China and India, the two biggest consumers in Asia, for more crude imports and also sort of any movement on the product side?
Yeah, hi Dayala. Good to be here. Let me take China first. I think I echoed what Jenny had said. 2-3 major points we have to take about China. One is there's a lot of optimism about China. I mean, we looked at the GDP growth forecast, which has been moved up. But if I look on the flip side, if I look at one of the key indicators, it's the steel consumption in China, that still looks to be a little bit flattish. So therefore, I'm still a little bit skeptical about the growth rate in China. The second data point which has come up, crude imports into China has been strong. Refinery rates has been good. But there's been a bit of stock buildup in China also. If you look at the product stock across China, so there's been a bit of buildup in China. So therefore, like somewhere on the way, one does get a little bit of doubt whether how much this demand is going to hold up. So, but anyway, nevertheless, I think I'm sure the consumption in China is far better as compared to what it was, let's say, 2 or 3 quarters back. So that's a strong indication for the products as well as crude demand into China. So I think that's a very big positive factor for OPEC to consider. Now, secondly, coming to India. Now, India is moving really well, pretty strong, despite the fact that we are a fag in the election season. The demand outlook looks very strong right now. And I think there's no way do we see any weakness in demand coming out in the next 2 quarters, which are supposed to be strong quarters from the economic perspective. If you look at India's imports, that's been pretty strong. India's refinery run rates has been pretty strong. And then, even the product demands, especially look at diesel and gas, and that's been pretty strong. So therefore, looking at China, India's demand has been pretty strong, which is a good positive indicator for OPEC to consider. Now, I think the debate that was going on is whether OPEC should consider anything to do with the cuts, and they need a price between 85 to 90. Now, another point to consider is the output from Mexico has dropped. So if you look at the market balance itself, I think if you look at a strong demand coming out of China and India, plus, a little bit of natural cut that's happening in countries like Mexico. So I think my view is probably OPEC will not actually tinker around what they've done already. And one of the indicators which I always see is this time it's a virtual meeting, not a physical meeting. So probably it's going to be a easy meeting as compared to, let's say, a tough meeting. That's the way I look at it.
Thanks, Ram. Thanks for that. Kara, let's talk. I mean, Ram mentioned Mexican production. Let's talk a bit about US production and sort of non-OPEC production, because again, another big question mark probably will be discussed more at their meeting than anything else. We might not know about that, but is this non-OPEC sort of market share, if you like, that's creeping in while OPEC Plus maintains its volumes, because it has to. It's kind of stuck, isn't it? It can't do anything at the moment, as we discussed. And yet other producers are sort of profiting from these healthy prices. I mean, do you see that becoming more of a concern as we move through the year for the OPEC Plus group? And then you have the internal disagreements on capacity and quotas as well. So, will we finally see that rear its head in the second half of the year as a topic of public discussion?
If I remain focused on the short term, so without taking a longer term perspective, because this is where you think about investment outlook and potential supplies. But look, shale is here and it's been with us since primarily 2008 when the shale revolution happened, but since 2010. And on balance, many have underestimated the resilience of shale. It's not going to disappear anytime soon. We may see some slowdown at some time, but I also expect the private sector to maintain their activity and their investment, and also think about the elections, presidential elections. If there is President Trump coming to the picture as well, that the US production can receive further boost. So on the US front, the US is leading non-OPEC plus supply, but it's not just the US, it's also the Guyanas of this world. The new kid on the block, Guyana, hardly anyone forecasted Guyana's production several years ago, and now it's always among the top 5 supply growth because of investment taken many years ago, and it's not going to disappear anytime soon. So there is that reality that the market, of course, OPEC Plus remains an important group, around 40 or 40+% of global supplies, but there are other important players that are sharing the pie with OPEC Plus. In a sense, it's healthy. But it depends also, it's not just on the growth, it's the growth rate that matters versus the demand growth. So that's why I don't like to focus only on one aspect of the market. So it's not enough to focus on one particular angle, that is US shale, but how does this fit with the broader picture in terms of demand growth as well, because that will impact the direction of the market. What is happening also outside those growth areas, because we do have significant decline rates elsewhere. So we have to think about the net effect. But on balance, I find US oil production has been, if you want to use the term, threatening, but it's not really threatening, but it has been playing an important role in readjusting the market share and market power in global oil markets. It's not going to disappear anytime soon, but they are not the only players in this big complex scene.
Yeah. Yeah, and I mean the other thing we're seeing on the US side is, of course, this more of this consolidation between the producers there. Another announcement yesterday on ConocoPhillips and Marathon Oil, and there's been different arguments made there whether that'll actually help shale production or not, or just consolidate everything as that shareholding becomes more concentrated. Yaniv, just to go to you, mentioned the sweet sour grade discrepancies partly because I suppose of these OPEC cuts and that oil being withheld from the market. Where does the Russian sort of oil flows also give us an update on how that's fitting in to things in terms of any discounts being offered? Where is that discount into Asia? And is it shifting at all in the last few weeks? And what do you foresee for Q3 for that?
No, I just want to build on Carol's point a moment ago as well, right? So we're looking at the sweet sour differential, but also looking at non-OPEC supply, the US, Canada, Brazil, etc., and Guyana, providing a lot more of the lighter, sweeter barrels onto the market. And this is at a time when there's a significant amount of already producing grades of this kind from the North Sea and from West Africa as well. So in terms of tightness, it's really within the sours, medium sour. Of course, these are the types of barrels which are really required right now for looking at a yield perspective within just an average refinery that produce the middle distillates, the diesels, and the jets, which are really supposed to grow in our forecasts through the rest of this quarter. I think coming back to the question as well, understanding what Russia's viewpoint here, or how Russia is continuing with. I think Russia doesn't have much wiggle room apart from what is already agreed with the OPEC Plus agreement, with just not on crudes but on products as well. So we have to remember here that the OPEC Plus agreement is varying for different countries and at different time periods as well. But in terms of where Russian flow is going to right now, of course, China is taking a significant amount, as it is of Iranian barrels. But Russia has recently just penned or inked a deal with Reliance Industries within India to continue taking a term nominations of up to 3 million barrels monthly. So, some of that is, again, subject to different considerations. There is 1 million barrels that is fully accounted for, but then there's an option for further purchases up to 3 million barrels, or an extra 2 million barrels at a discount of $3 or so. So, Russia is entering into the market into different phases, and it's continuing to, and I think it will for the foreseeable future, just because of the type of the barrel that's required on the market and the significant OPEC Plus in the Middle East cuts.
Okay, thanks, Johnny. Ram, I mean, on that Russian, again, sticking to Russian crude, I mean, we did see some stronger sanctions, I suppose, coming in on the shipping side earlier this year, which are meant to try and at least decrease those revenues for Russia, if nothing else. But also we do have, I mean, Johnny just mentioned about Russian crude going into Reliance and those refineries there. There was an issue of payment, wasn't there, earlier this year? And there was a bit of a pause in taking Russian crude. Has that all been now resolved, or, is everything running smoothly on that front?
Yeah, I think that's a very important point. In fact, when I mentioned in the same call last month, I think Russia's crude imports into India was 35% as of March. In April, moved up to 40%. And Reliance is what Jenny mentioned right now. Now, one of the major issues you rightly mentioned was the payment. So India had resorted to different kinds of payment, paying in dirhams, paying some in rubles, even paying sometimes in yuan also. So whether the issue has been resolved fully, I would say no. But various routes have been found out because of the due to which payments have been done. India is also trying to increase its exports to Russia. So therefore, that's another way that the trade balance can be maintained. And then big companies like Reliance have found various other ways to do it. So therefore, going forward in the future, I think the issue will get a little bit more easier. I think there'll be different ways of payment, different ways of shipment that will be people find solutions to. For example, in case of shipments, some of the sanctioned shipping companies were not bringing crude into India. They found some other shipping companies which can bring crude into India. So therefore, all the solutions have been found because nevertheless, finally, it's all about money, right? The deep discounts really plays pretty well into India's country's profit margins. So therefore, going forward in the future, the solutions will be found, and my view was 35 to 40% that number will continue.
Okay, thanks, Ram. Carol, I'm going to ask you to put your economist hat on, Dr. Carol, and let's talk a bit about macro. Let's talk about interest rates, Fed policy, central bank policy, even in Europe. You know, again, perhaps seeing more certainty these days that we're already halfway through the year. People are saying we have room for perhaps one rate cut, if any, for the remainder of the year because of the elections. So are we seeing more stability on that front from that point of view? And therefore, how is that impacting, you know, oil demand or forecasts for that and economic sentiment in general and the impact that it could have on oil into Q3, Q4?
I would say, I mean, when it comes to we have more certainty, I will have to question that because, yes, we may have perhaps more certainty in Europe, whether in the UK or with the ECB in the EU, because they seem to have greater kind of determination to start cutting cuts at some point. But we don't have that with the US Federal Reserve. On the contrary, I think that today people are wondering whether we're going to continue with this higher for longer. Because the picture, while we had positive signals at the beginning of the year that maybe we're going to see some cuts, that kind of positive or optimism has kind of faded away and has been replaced now with a more conviction that there could be actually interest rate may not be cut this year because the data has not been consistent or supportive of the Federal Reserve changing its policy. So on the US front, I'm not quite sure. It seems that we might stay in this higher interest rate environment for longer. And that by itself as having an impact on the health of the economy and potentially on oil demand. But I want to highlight also one thing, and maybe Janif can elaborate a bit more on that, because I was scanning quickly the data for the US this morning, and I saw that actually gasoline demand is not as high as many would have expected it in the US, actually weaker. We usually expect at this time of the year to have gasoline demand being stronger in the US, but so far it has been dampened. And I wonder, I mean, from an economics perspective, that all this spending and resilience to high prices that we saw, whether it has reached an end, because don't forget that people who received lots of generous handouts during COVID, they kind of spent all whatever they could spend, and now they are being much more cautious. So that would be something that we should also consider when looking at oil demand in the US.
Yeah, I mean, Janif, let's get your response to that in terms of gasoline first. Let's look, we're in the heart, you know, we're kind of in the heart of the driving season now. We've seen what's happening to inventories weekly, at least in the US. Do we expect a similar season to what we had last summer, for example? And let's talk a bit about jet as well, if you can address that.
Absolutely. No, thanks there. It's a good topic. Of course, it's very relevant at this moment in time. We are seeing some weakness within the US gasoline front on a real-time basis, on a day-to-day understanding in terms of consumption of and road vehicles usage, with some limited growth, I would say, for the rest of 2024 compared to where 2023 landed at. Of course, this is obviously a function of how the macro, the politics angle, as well as the pricing does play into it. But you're looking at some potential SPR releases from the US, which could ease prices and sort of spur on consumption. Looking at refinery run ramp up within the US, yields of gasoline are of course going to drop by a touch, but they will still drop. But that doesn't play away from the fact that gasoline supply will still be relatively well in the US, but of course the wider Atlantic basin. You've got a couple of new refinery projects due to start up, Dangote in Nigeria, as well as Pemex Dos Bocas or Mecca in Mexico. Of course, both on varying timelines as well. Coming to the jet point, the demand view in terms of growth for this year is significantly skewed. Partially, the 1.5 million barrels a day growth year on year is skewed towards the middle distillates, gasoline, diesel, and jet. And of that jet is growing by sort of 600 KBD, and much of that is within China. Now, from a perspective of what type of product it's those middle distillates, and where is it regionally within Asia? So the rest of the world, so world excluding Asia, is fairly flat, some potential, some growth, but Asia is a real growth factor. So coming to the Atlantic Basin, Europe and the US mostly, year-on-year growth is fairly muted. It's basically following the seasonal patterns. So pretty much all eyes on China, how China continues its run forecast, how outages do continue, and primarily based on the oversupply of diesel and how cracks are moving compared to this time last year.
Okay, thanks. And of course, I mean, I'll go to Ram next about Asia again, but let's look at that survey question. What's OPEC likely to do if prices don't hit their desired, what's everyone's saying, they prefer it to be nearer 90 or 90 plus in the second half of the year? What are they likely to do? Will they possibly deepen voluntary cuts that are in place beyond the 2.2 into Q4 if they see that price not shifting, or will they just continue to commit to current volumes and just make that firm commitment to the end of the year? So we'll see what everyone thinks about that. Ram, let's talk a little bit about, I mean, just to pick up on Janiv's comments on that sort of jet gasoline, but I mean, and again, back to oil, because it does seem to be lagging. And again, it's probably just a supply. The answer is too much supply. But I mean, you mentioned steel, you mentioned demand into China. Just commodities in general are sort of getting a big boost from inflation. It's kind of, I suppose they're boosting each other. But oil is still lagging behind. Oil is cheap. That's what everyone keeps saying. Is that simply to do with oversupply, or do you see that trend continuing, i.e. oil will continue to lag behind other key commodities?
Okay, let me just give a different perspective. If you look at different other commodities like aluminum, copper, steel, and all of them were a little bit undervalued till last year. And these markets mainly play on supply and demand. And I would say, they're not as much control as what oil market is. So given the positivity in the Chinese economy, the outlook for the Chinese economy, that's where all the prices have shot up. Copper has crossed 10,000, aluminum has crossed 2,700 and so. So therefore, that's what has happened for the commodities prices. Now, if you look at some of the consumption numbers within China, they don't seem to support such a steep hike in the commodity prices. And that's as I mentioned about steel consumption in China. Similarly, we are looking at the aluminum consumption in China. Everybody's talking about EVs and solar panels driving the demand, but they hardly account for 15% of the total consumption in China. So how can they drive up such a big increase in prices? So therefore, somewhere along the way, a lot of optimism has been built in the commodity prices. So that's what has pushed it up. So therefore, China's performance in Q2, which is the present quarter, which is a peak economic season in China, will really show whether China has really moved forward in its economic growth at all. So that's one factor which you have to watch out by the end of June or in July, and that will play a true in that will show the direction for the commodities prices. Now, coming to oil, is it oversupplied? Frankly, I don't think so, because we have a well-structured organization which is controlling it. But oil already had gone up a bit. There was a bit of so-called fear premium which has been built up into it. I think if you look at pure supply demand, oil should be at 70 or 71. Today we're at 82, 83. There's a bit of fear premium which has been built up into it already. And if you look at what happened after the recent Hamas and all those things that has happened, oil has moved up quite a large extent to what happened 2 years back when Russia-Ukraine war started. So looking at it, oil already had a bit of premium that was built up into it in the pricing in the last maybe 6 to 7 months or so, maybe the last 1 year or so, which was not there in the other commodities. So therefore, that's why you don't see such a big increase in oil. That is number one. But the demand growth, as what Janiv mentioned, especially aviation fuel, that's grown up, that is really picking up in a big way, not only in China, in other parts of Asia also. And we see a drop in demand in diesel, what he mentioned also, because some of this economic activity shifting more towards the other side. So therefore, we see a drop in diesel, but a big increase in aviation fuel and gasoline also.
Yeah.
So therefore, from a demand perspective also, there's not been a major drop for oil because of which the price has not moved up. It's because of the way the oil markets are structured and the different way the commodities markets were structured.
Yeah,
that's,
and also
that's where the difference.
We happen to have 5 to 6 million barrels a day of capacity just sitting on the sidelines
now,
which
that's
don't
right.
have of cocoa and we don't have of copper, for example. So it's going to take time for that to sort of shift through the system. Carol, let's not finish the session without talking a bit about geopolitics, or at least the elements that feed into that. We've seen, the risk premium kind of negated out of the market for the time being in terms of the situation in the Gulf in terms of the Straits of Hormuz, risks there, etc. Do you, I mean, you can't predict, but I mean, is the market now basically negating any of that risk coming back? Of course, putting aside an unexpected event or escalation. And I also wanted to ask you, we have an article about Iran on our news bulletin launching new projects, $4.8 billion of new oil projects. Iran's output has increased by 20% and exports over the last year. It has had a pretty good trajectory the last 2-3 years. Will that continue? Do you see that making a mark on the market?
First, I'm glad that you brought in geopolitics, because I was thinking earlier we're almost towards the end of the session. We did not mention geopolitics, not even once. And that by it's, even though the war in Ukraine is still ongoing and is getting various developments, the war in Gaza is still ongoing, all these tensions around the world are still happening. And yet it seems that the geopolitical risk premium seems to have dissipated from oil markets. But again, this is a reminder, because don't forget, many people have got the impact of the geopolitics on oil markets wrong, because they zoomed in on the potential supply disruptions, which did not happen. They forgot the liquidity that we have in the market, how fluid the market is, and also the spare capacity in the system. We tend to overlook that, which is above 5-year and 10-year average. So in that respect, no, geopolitics will always have an impact on the oil market, but we're not anymore in the 70s. So that's something we have to consider, like how far the market has evolved since when geopolitics were playing a much more direct role on oil markets. Not to say that this cannot happen, if there's a major development in the Middle East, is not going to have an impact on the oil market, but it's not anymore like it used to be. If the Middle East sneezed, the rest of the world would catch a cold. The market realities have changed significantly since then. On Iran, I would be careful. I would distinguish between two things. Just putting in the market what Iran has been already producing, but was limited because of the sanctions, and then a weaker implementation of the sanctions, particularly since the Biden administration came to power, kind of allowed Iran to put more of the oil that was already producing in the market. So that is one thing. But the other thing, which is very different, increasing the capacity, increasing future production. And if you look at Iran's various projects announced over the last maybe 10, 15, or even I would go further than that, you would see that they have always been promises, big, ambitious projects, but they have failed to materialize because investment did not come. Who is going to commit the billions of dollars in Iran under existing circumstances? The Chinese are not desperate. They would do it maybe because they want to gain certain political leverage and for political reasons. But so far, and I've been observing Iran, studying Iran for many years now, all the big projects requiring the billions of dollars, even if you go into memorandum of agreements or all sorts of memorandum of understanding, MOUs or heads of agreements, they kind of stop short in terms of the commitment, serious commitment of capital to allow Iran to go beyond what it's already producing. So that's really my take about Iran, unless we see some serious change in the sanctions policy. But again, you have to think about the impact of politics and perhaps Trump coming back to power, and what can happen, what can Iran deliver under those circumstances.
Yeah. Well, I'm sure that'll lead to some change in the current dynamic, certainly, if we see Trump winning, and that's looking very likely these days. Let's have a look at the response there. We've got 62% they're saying that they would commit to the current volume. So more of the same, very unlikely that, although we see quite a few people saying deepen the cuts, and that would be really something, wouldn't it? Because a lot of the commentaries that Saudi is not going to do any more itself to sort of support, I suppose, everybody else. So we'll see what happens. Ram, just before we sign off, I wanted to go to you. We're almost done with the Indian elections. I mean, it's a long process. So let's get your take. I think no doubt that Prime Minister Modi is going to win, correct? But I mean, do you see, again, any immediate outcome economically for India? Will it get another boost to its already healthy GDP when Modi comes back with his victory lap, or is that already built into, let's say, markets in India?
Well, markets are built into a large extent. In fact, yesterday he gave an interview saying that, while his election campaign is on, his people are already working for the next 100 days or the next 3 to 4 months. So markets are factored in.
But his majority is going to be shifted, isn't it, within the parliament? There is going to be a slightly different dynamic there, no?
Well, that's something which you have to watch out for. June 1st, you'll get no exit polls. I mean, the thought process is if they get the same number of seats or increase the number of seats, market will get a big boost. And if they drop the number of seats, maybe markets will react negatively on Monday. So therefore, the big question is like, how many seats are they going to win? Not necessarily who's going to be the winner. So that's what the major topic that's being discussed right now. So anyway, June 1st, we'll get the exit polls and June 4th, the election results. So therefore, yeah, it'll be pretty interesting next 1 week for us, all of us out here.
Absolutely.
And if you're interested in Indian market, I think you watch it for your investment. That's what I would say.
Yeah. Okay, great. Okay. Thank you very much, Ram and Dr. Carol and Jani for joining us this morning. A big week ahead. We'll see what happens in India. We'll see what OPEC comes up with. And I'm sure many other developments will pop their head up. So thank you so much, everyone. Have a great weekend.
Thank you.
Thank you. Yeah. Take care.
Bye-bye. Thanks.